Welcome to Stop Hunting, Support and Resistance Secrets, presented by me, Mark Chapman, the creator of the trademark Trap Traders concept. What you're going to learn in the coming slides is some of the most powerful trading information I've ever shared, so I hope you take this seriously. Turn off your cell phone, lock the door, grab yourself a pen and paper, and give me your undivided attention, and in return I'm going to provide you with some of my most closely guarded trading secrets. So without further ado, let's get into this. Stop hunting is real. If you've been around trading for any length of time, you'll know of this conspiracy that floats around in many of the trading forums on the internet. So whether it's a conspiracy or just a function of how the markets operate, regardless, the facts still remain. If you place your stop losses where everybody else places theirs, you are going to lose a lot of money, and trading is going to be extremely difficult for you to gain any traction and consistency. The reason for that is that the market seeks out liquidity. That's how it advances and declines. It's not some mythical godlike invention. The markets are man-made, and it will always head towards where the money is. The market almost has to feed off itself in order for it to advance, collecting the biggest orders until there's none left, and then off it goes searching for the next batch of orders, which is oftentimes in the opposite direction. And just like a snake that has to coil and weave and swerve to advance, oftentimes the market will resemble this image. No sooner does it go up, it goes down just as far or further in the opposite direction, and so on and so forth, feeding off itself in order for it to advance. So what is liquidity? Well, it's money, and I'm going to explain how you can see this in more detail in the next couple of slides. By understanding the markets from this perspective, it puts you at an advantage to your opponents, because you're not going to make the same mistakes they perpetuate on a daily basis. You're going to be smarter than that, so that you can avoid the traps set by brokers and large institutions. So where does all this money sit? In and around key levels of support and resistance, making it easy for large orders to be filled, because where there's a build-up of liquidity, major players can fill their orders without too much slippage, and slippage with huge size is clearly a considerable disadvantage, because you won't get filled at the price that you want, and as a consequence of that, it will cost you money. So it's almost like a business model. Big players can't get filled where there's no liquidity sitting. And because they are the guys and girls who can manipulate the market, it makes all the sense in the world that you keep getting stopped out. If you're new to trading and you're going through this information, then you're one of the lucky ones. But for the most part, people with experience will have been stopped out many times, only to see the market turn around and go in the direction they had chosen, however, without them on board, because they'd already been stopped out, which is beyond frustrating. Does this chart look familiar? Support and resistance rarely holds, and you know this to be true if you are experienced. This would be considered very typical, where there's a clear level of support or resistance on a chart and price just breezes through those locations and takes out any stop losses that you may have had placed for protection. No sooner did you get stopped out, your money's gone, the market turns around and goes in the original direction that you had planned for. But as I said before, sadly without you on board. And while support and resistance is often described as a sound trading strategy, in reality it's terrible. So what is support and resistance? The best way to think about resistance is that it's the ceiling above your head, and support is the support on the floor underneath your feet. But there's a very big problem with this strategy, because your stops are very easy to see, making it simple for a market manipulation to occur in and around those locations, to allow for those large orders to transact, because the liquidity exists there, which allows them to fill those orders without suffering slippage costs, is the core reason why you continue to be stopped out. Stop losses, or stops, accumulate below price in an uptrend. If I was to ask you to think about where you would place your stop loss if you were trading retracements in an uptrend, I'd wager you would place your stops in and around these locations on the chart. Can you see now where there's a lot of money sitting? Think about that for a moment. The way we make money as traders is we take money. All that money just sat there building up. So given the nature of this business and how money is attained, this is powerful information to think of it in these terms. Stops will accumulate below price action in an uptrend. The more obvious the move, the more traders will see it, the better it will be as the chances build for a reversal, so those big orders can be filled. Stops accumulate below price at support. Support and resistance are some of the easiest areas to spot on a chart where money will be building above or below price. There could be some debate about a swing point in an uptrend, but there's no debate about a horizontal line. So if price comes down to a level of support and bounces off it several times, you can be sure that stop losses, liquidity, money is building below that location. Now it's not an exact science in terms of where this money is, because you could have somebody who placed an order to be stopped out 5 pips below this level, and then the next person 10 pips, and then the next person 20 pips, and then the next person 30 pips, and so on and so forth. But there's a build-up of money below that level at varying points until there's not, and this phenomenon occurs at levels of support. Stops accumulate above price in a downtrend. And finally, stops accumulate above price at resistance. We don't know precisely where these stops are, but it's fairly safe to say that there's a big build-up of them in and around that location. And there are a couple of core reasons why. First of all the education tells a trader to hide behind structure with their stop loss. It's not that that's not good advice, it's just slightly misguided, because everybody's doing it, which makes it easy for you to be targeted and predicated on. The other is that people are trying to manage risk, and they may be restricted by account balance, which means they can't give it too much room above these levels, which is another reason why stops and liquidity will build above these locations. This course is not about fluff and filling the presentation with useless information. This is actionable intelligence you're going to be able to use once this course is finished. So sit tight and get ready for some of the best trading information that's ever been revealed. But first, some backstory. As I mentioned earlier, the biggest problem traders face is whether or not levels of support and resistance are going to hold. And if they don't, what's the difference between a level holding and one that doesn't? Is there a way of being able to understand this? And for a long time, I struggled with this, but then I applied some lateral thinking and came up with the information I'm about to share with you. Lateral thinking is solving problems through an indirect and creative approach, using reasoning that is not immediately obvious and involving ideas that may not be attainable by using only traditional step-by-step logic. The term was coined in 1967 by Edward de Bono. A picture speaks 1,000 words. The support and resistance secret trading tactic is going to require you to think outside of the traditional norms. You have to reside in a space most traders dare not tread. This fictional character Morpheus in the movie The Matrix offered Neo the opportunity to take a red or a blue pill. So I'm going to give you the same choices that he gave Neo. This is your last chance. After this, there is no turning back. You take the blue pill, the story ends. You wake up in the morning in your bed and you believe whatever you believe about trading and stop loss placement. You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes. Rules of engagement for breakouts. And when I mean breakouts, I mean real breakouts. Breakouts that are actually going somewhere. The market does advance to new value areas. The problem is, a lot of the time, it fakes out those moves and doesn't advance until after several attempts. And this is the problem, because in the meantime, you get chopped to bits and spat out by the market several times, and you can lose a lot of money. So I'm going to show you the difference between a breakout and a level that looks like it's broke out, but it has in fact held. And you're going to know the difference between the two things, which is massively, massively powerful. Rule 1. Price must pass the eyeball check. Does it look like it's a strong breakout? Rule number 2. Price must clear the level by a minimum, but it can be more, of ×2 candles that close above or below the high or low of the previous candle in the sequence. A candle trading above the high or the low of that first candle in the sequence is not good enough. This is a telltale sign that the move is not legitimate and it's more likely to fail. So we need 2 positive closes where the close of the prior candle is lower than the current candle. So it's essentially the minimum measurement of a mini trend, because a trend can only be distinguished by a minimum of 2 candles or more. So this is true to the upside and it's true to the downside as well. Rule number 3. None of these candles must intersect with the level itself. They must be free and clear. The open, the high, the low and the close. So those 2 candles in the sequence must be above the level, open, high, low, close. They must not be touching the level in any shape, way or form. Rule number 4. Price must not have travelled from one end of a range to the other. These are low probability entries, so you've got to watch for pullbacks under these circumstances. If price ever comes back inside the level, it's not a trade anymore. It's a no trade, and you can nix it and move on to the next event. So watch for consecutive candles into a level that starts to break. If you've got 3, 4, 5, 6 or more candles in a row and that price action has travelled from one end of the range to the other, it's unlikely that it'll follow through. A retracement is much more probable. Rule number 5. Price must have been making a series of higher highs or higher lows or vice versa prior to the breakout occurring, which is a definition of a trend. If you have these things in place, you should have confidence that the market is on the move. And this is the type of breakout that you would want to consider versus the breakout that just continuously fakes you out. Okay, so here's an example of a real breakout. First of all, you have a level of resistance, and it's always wise to have a minimum of 2 touches to any level of support or resistance. Resistance in this case. So price breaches the level. You see how it still intersects with the level? So this candle is not part of the sequence. Price action has not travelled from any great distance, so it hasn't travelled from one end of the range to the other, which would be a low probability breakout. Rather, we've had some trading in and around this area, nice and close to the level, so this is good to go. Next, we want to see 2 positive closes. This first candle closes here, and the next candle doesn't manage to close above the high of this candle, which is the first candle in the sequence. This next candle closes strongly, and this time, however, we get a close above the high of this candle, which is the first candle in the sequence. At this stage, we have 2 positive closes, which is the minimum requirement for you to take a trade. Prices were making higher lows, and this is a new high in price. The 2 candles represent a trend, and we have several open high-low closes above and beyond, free and clear of the level of resistance. So I'm confident this is a good trade to take. So all we need to do now is wait for a pullback in price, because you never want to be buying at the highs or at the lows. Always look for a deal. Never buy at retail prices. Always look to do business at trade or wholesale. It makes the most sense, and if this price action has truly broken out, you'll have nothing to worry about. Just stay patient and let price come to you. There are several ways you can look to enter into this trade. You can wait for price to pull back into this prior level of resistance, which oftentimes becomes support. If, however, the move is so strong that it's unlikely it will retrace that far, you can always stick a Fibonacci on the chart and look for entries off key levels, plotting the tool from where the move originates to the high. And the entry trigger is a 2 candle entry, and it's very effective but simple to use. We have a level where it's been touched a minimum of 2 times, and then it finally breaks out at this point. The next candle, the first candle in the sequence, is this candle here. And if you know about candlesticks, this is a hammer where the bears won the battle, even though it closes positive. So I would already be concerned about this trade. Also, we have multiple bull candles in a row. 1, 2, 3, 4, 5. Which is starting to get up there on the candle count. The dynamic of the market is that price retraces. So if you have 7, 8, 9, 10 candles in a row without any retracement, it's unlikely that will continue. You should expect a minimum of a pullback in price. The next candle, although it trades above the high of this prior candle, so the second candle in the sequence does go way beyond that prior high, however, it fails to close above it. And again, so does this third candle. So when witnessing this in real time, you have to believe that this is not broken out. This is a stop hunt, and all those breakout traders have had their orders filled, and all those resistance traders who are hoping for price to go down place their stop losses above the level, create demand which drags price through the level. Makes all the sense in the world why levels don't hold, because them orders are getting satisfied. So most of the time they will go beyond the level, only to fail and then follow through in the direction that most traders thought it would, but without them on board. Then we get an engulfing bear candle, followed by several doji candles and spinning tops, which is indecision, and not exactly the type of price action synonymous with a strong breakout. Then we get the 2 candle negative entry trigger, which I'll go into in more detail in the coming videos. But basically, price goes up first after the close of the first candle, then the second candle starts to sell off, and we pull the trigger and go short. It's a very simple entry process, but very effective. Also, if breakout traders are still in these trades hoping for the price to follow through, if you enter short here to the downside, you've got the psychological edge, because those traders are losing money, and that's always a good place to put yourself in whenever you enter the market. Another example of a real stop hunt. You have a level of support, price bounces away, so there's your first level, comes back, and breaches that level. This is not a level that's broken. Remember what we need to constitute a level break? 2 candles with positive closes. Open high-low closes, free and clear of the level. No candle intersection at the level. Passes the eyeball check. None of this is present. However, a 2 candle entry is shown in this green circle. So you get a positive close and then you get a second candle that drops lower first, flips and turns bullish, and that's your entry. You don't even have to wait for the high of that candle to breach, but if you want to, for extra confirmation, you're more than welcome. The point is though, when price comes against you again here and here and here, none of this constitutes a break. Do you see how powerful this information is? You know it's not a break. So don't get obsessed about the immediacy of price, profit and loss at the hard right edge. The hard right edge is the void we all have to the side of the chart when placing trades. The fact is, although price might be dropping against you heavily, it doesn't constitute a break. So don't get fooled. Don't get sucked in. Don't panic. Stay cool, stay calm. Only use a small amount of risk, which we'll get into shortly, so that this doesn't bother you and you can think effectively in this moment. As prices drop lower, of course, your trade may be underwater slightly, but it hasn't broken, and now you know the difference, which provides you with a huge edge over your opponents. You knew this area here had not broken out to the downside. However, anybody who was placing stop losses below this level of support, imagine price had been there at that level several times, there's a build up of liquidity. Big traders force price below that level to swallow up all those orders, which are supply orders. If you buy in at support, your stop loss order would be a sell order. Even though if price stops you out and closes that position, you may just think it was a close. That's not true. If you were buying and you place a stop loss, it's a sell order, which is why so many levels breach, satisfying those orders, but then are overwhelmed by demand or supply, in this case demand, and price goes in the direction where you knew it would. However, for the vast majority of protagonists, they get stopped out at these levels, but you don't. You're able to manage risk so that this isn't a problem, you stay in the trade, and you're in the sweet spot, which places you head and shoulders above the rest. Essentially, you're Neo, dodging bullets in the movie The Matrix. If you've not seen that movie, I strongly encourage you to watch it, so that you understand the analogy. He was learning martial arts, and he was really good, but he couldn't quite go to the levels of which his teacher was saying that he could, where he became fluid, liquid, where he could dodge bullets. Where everybody else is getting stopped out levels of support and resistance, you're dodging bullets. You know the difference. You're in that sweet spot, that zone, that control. And although you can't control the markets, you can control how you respond. You can dodge bullets. And with this information, you will. So this is an example of what dodging bullets looks like on a chart. This is Neo dodging bullets. Everybody else is getting stopped out of their trades and are very unhappy about that. On the other hand, you knew this hadn't broken properly and that the upside was still in play. All that was happening was prices were being dragged beyond the level to satisfy those stop losses and breakout trading orders, and as soon as that had occurred and all that supply had evaporated, prices head your way. And during that trade, regardless of the negative price action against your position, you were able to remain aware, cool, calm and collected in the moment, understanding that that hadn't broken at that point, which meant that you realized the difference and that this was just a stop hunt, which is a massive advantage. So another example of Neo dodging bullets. Morpheus told Neo that he was the one, and now you are the one. You can dodge bullets just like Neo. As prices breach this level of resistance on several occasions, but rather than be stopped out, you understood that it hadn't broken out at this point. This hadn't broken, this hadn't broken, and this hadn't broken, giving you multiple opportunities to sell this market and make money to the downside. Where everybody else was being stopped out or shot by bullets, you weren't. You were able to understand it, rationalize it, go through the steps logically, and realize that the market was just hunting those stops, sucking up that liquidity prior to it turning and heading down. So the 2 candle entry trigger, you've got your level of support and then it breaches, so this is the stop loss hunt. We're then looking for one positive candle close, which is what we got here. The fact it's an engulfing candle, engulfing the body of this negative candle, is a good thing to have, but it's not the end of the world if it's not there. The positive candle close, providing it closes closes near its highs is okay. Next up, we want the second candle in the sequence to head down first. Down, creating this wick, and then flip from the open, which is this area here, and go positive. Now, as soon as it goes positive, don't pull the trigger. Wait patiently and allow prices to firm up once or twice. So what I mean by that is, it doesn't just go green and then come back to the open. Go green, come back to the open, or worse, go back below the open and turn negative. You want it to go green, pull back, but then hold some of that green body above the open. And that's prices and bids, in this case, firming up. You want to see that a couple of times. Allow it to do that, which will give you the best possible chance of timing your entry. Nothing's 100%, but this is a really good entry trigger, and one that I use myself every day in the markets. Next up, I'd encourage you to use only 4-hour and daily time frames for this trading. I highly recommend that you do this because lower time frames is only good for a certain group of people, and that's brokers. Brokers encourage you to go down onto those compressions because it's hard to stay focused. You're more likely to make mistakes down there with the cut and thrust and noise of price action. You'll also likely take many trades, which is great for them as they get paid commission or spread on every trade that you take. So the more, the merrier. Don't get sucked in, don't be fooled, and don't think that trading the high time frames is boring and inactive. Nothing could be further from the truth, and every successful trader I know trades off the higher compressions. So I suggest you do the same. Never risk more than 0.1%. I repeat, 0.1% of your account balance on any one trading idea. 0.01% would be better. If you can return 1% per month, you'd be a trading rock star. So don't believe the hype and the distortions built up around these numbers. 1% per month consistently would mean that you are outperforming some of the most successful and well-funded hedge funds on planet Earth. Only ever take trades where the potential exists for you to return a minimum of 2 times your original stake, a 2-to-1 reward to risk ratio. And never, ever risk 2% on a trade. It will only end in tears. I hope you found this information valuable and you're excited about using it in the markets. Never bet the farm. The outcome of the trade is irrelevant on a micro level, but the more trades you take, the closer you'll get to profitability. Take a good trade, the outcome is the outcome, and simply move on to the next independent event and rinse and repeat. Wishing you every success in your trading endeavours, and I'll see you in the trade room. Take care and good trading to you.